Hi, I'm James Dunn. Welcome to the Inside Network.
Welcome everybody to INDepth with Roy Keenan from Yarra Capital Management. Roy, the Yarra Capital Enhanced Income Fund has never missed a distribution in over 2 decades. Why is this consistency such an important factor for financial advisors and their clients?
Yeah, it's a really good question. I think it's more, as we think about the transition that is taking place, I hate referring to the boomers, but, there's no doubt there's a big shift in, the retirement people moving to that sort of age where they're seeking income. Mm-hmm. And, a fund like the Yarra Enhanced Income Fund does have that consistency. It's been able to prove that over a long period of time. And for me, going back, probably 15 years ago, I remember, because I'm a fixed income guy, I tend to be a bit more conservative. And I remember reducing my distribution some 15 years ago. And not materially, but a bit more conservative. And the phones rang off the hook. And it reminded me the importance of the consistency. They rang so much that my client service team made me answer the calls.
Wow.
So I learned a valuable lesson about that consistency and how important that income is to our clients.
And you target a cash return plus of 230 to 280 basis points above that of the cash rate, but you've actually outperformed that over the long term. How do you strike that balance between driving outperformance and preserving capital?
Yeah, I think, from my perspective, when we set this fund back up in 2002, it's probably the thing I'm most proud of is that we designed it to do that return, and achieving it over such a long period of time, I think, testament to our investment process, the team I have, which is probably the best team I've ever worked with, and the experiences that you gain along the journey. To have that consistent outperformance, it sort of means the fund's set up right for the marketplace, but also the process that you're driving, that bottom-up research from a credit point of view, which is so important, but it needs to work with your macro environment as well. And I think that's the thing, your process evolves over a 20-year period, and I think we're in a space now where we've got that right. And that's why I'm really confident about delivering those excess returns into the future.
And how does the fund's structure enable you to be nimble in volatile markets?
Yeah, I think it goes back to the previous question. When we, whether it's luck or good management, when we set the fund up, and we haven't changed the fund in over 20 odd years, we're actually thinking about how does a fund maneuver through markets. And I think probably the one key thing is we don't have, we have a cash benchmark. So it means that we can think about risk-adjusted returns. And we're not forced to buy things we don't like, which is so important, right? And, investing in something that is really good and gives you a great risk-adjusted return, but also avoiding things that are bad investments, whether it be just because you're not getting paid enough or because you're not comfortable with the credit, is really important. And I think, that's one part of it. But the other part is also giving, and I think this for any investor, if they're looking at any fund manager, do they have the flexibility in the fund to actually maneuver through markets and the macro environment that's given to you? And I know that from my perspective, the Enhanced Income Fund has that flexibility. We can, dial up our credit risk, dial it down. We can actually move our interest rate duration up or down, or we can go negative duration. So, without being too risky, but within the parameters we're trying to deliver for that return of 230 to 280 over, we have enough flexibility to drive that return. And go a bit harder when it requires it, and wind back that risk when it doesn't.
And to that flexibility point, you've significantly increased your allocation to corporate hybrids and tier 2 bank instruments. What's driving those key decisions?
Well, first of all, we're really comfortable with the bottom-up research in banks. We think they're in just a really good spot at the moment. The current reporting period, You've once again seen NIMs improve. You've seen, arrears, whether it be housing or, finance, are still sort of at or below long-term averages. So it's a really good environment for the banks. Interest rates are falling as well. So we're really comfortable there. Yes, credit spreads have rallied, but we're still very comfortable from that risk-reward perspective there. Corporate hybrids have made a big comeback in the last 12 months. We've had about 8 billion of new issuance from various issues across the infrastructure sector, where we're seeing the clean energy grid being connected to the main grid, which is really costly from a capital point of view. And the one thing about corporate hybrids is that we're really comfortable with the underlying credit quality. And what we find with, when you buy corporate hybrids or subordinated debt in a company, you're talking about a 1 or 2 step down in credit rating, but you can actually pick up 1.5 to 2 times the credit spread. So we think that's a really good risk-adjusted return, and we much prefer in some of those companies owning their sub-debt than we do owning their senior, where we think you're probably not getting paid enough for the risk.
Risk management is clearly a foundational process. Can you please discuss and elaborate on liquidity and portfolio protection?
Yeah, it's, I think way I think about this is, I talked about flexibility earlier. Having that, because we don't have that against benchmark, we're not worried about being, for periods of time, under or underweight. So benchmark, is it hurting me? Is it not? So we can take probably a little bit longer term views on a macro environment. And if I use today's example, I think that's probably the best way to drive the answer here is that I feel today we're a bit like back in February and March before Liberation Day happened. Equity markets are fully valued, and I think today we're moving that way as well. There's some risk around the US economy. I think more risk around the US economy than we do in the Australian economy. So once we're looking at that top-down macro viewpoint, and we're obviously very comfortable having come through reporting season from the bottom up, it's like, well, how do I position myself from a risk perspective to take advantage of that macro environment coming up? Mm-hmm. And if I use today, then we're adding more cash. So I historically own 3 to 4% cash in my fund. I have 9% in my fund today.
Oh, wow.
So we are, still running a really high quality credit portfolio, BBB rated, BBB plus rated on average in the fund. That's the highest we've ever run from a credit perspective. And it's not that I'm concerned about underlying credit risks within my portfolio. It's because I'm a bit more concerned about the macro environment. And so we use these levers, whether it be moving up and down the credit curve, using a bit more interest rate duration to expose us to falling interest rates if we think that potentially the US could be moving into the risk of recession, or slower growth just in general. So they're the sort of levers that you want to pull, and having that flexibility within a fund to actually navigate those environments or set you up to take ability of, to take advantage of something that might be thrown at you is really, really important. So I don't think the world's going to end in the next sort of 2 to 3 months, but I think we'll see a risk off, which will then enable me to take advantage of that, just like we did in the fund back in April.
And it's interesting to note, like in the Spiva report that I was reading recently, it spoke about how when you're looking at active managers versus passive, particularly around fixed income, actually Australian active fixed income managers outperform a lot of the passive peers or passive benchmarks or ETFs.
Yeah.
Do you have any comments in regards to why that might be the case?
I think it also comes back to periods. Like the last 3 to 4 years as an active manager, it's been a great time for us because curves have been dislocated, macro environment's moving. It's really, I love it. You can tell by the smile on my face, I love that environment. Go back to zero interest rates and, trying to outperform in that environment where credit spreads are, were, not that attractive relative to how the economy was placed. To me, that was, really tough and, passive shone in that period, right? But when you have volatility, whether it be macro, or from a credit point of view, that's how we make money, right? And we have that environment today and we've had it for the last 3 years, and I don't think that changes over the next 2 years, which is pretty exciting for us.
And Roy, why is now a good time to be exposed to active fixed income?
Yeah, I think whether it be a traditional fixed income fund or in my fund a credit fund, I don't think it gets any better. And one of the reasons being is the actual income that we're generating. And I look at this fund today, we're somewhere around 5.75 to 6%. And when you get that much income, it does protect you against things that can go wrong, whether it be credit spread deterioration. And we go back to what you spoke about earlier in the question about flexibility in your fund. And we had a very recent test case back in April where credit spreads in my fund on average moved out about 28 basis points. And instead of having a negative month off the back of credit spreads blowing out or moving out wider, we had a positive month because we had a little bit of interest rate duration. We had a little bit more cash put away for a rainy day, leading into the volatility of April. We had yield curve steepening strategy on. Our view on the yield curve has been it'll steepen over a period of time. We've just moved from virtually a flat yield curve to now we're around between the 3 and 10 year part of the curve, about 90 odd basis points. So a combination, the way we're positioned, actually offset the actual sell-off in credit spreads that we saw. So that flexibility is really, really important. And if I look at the outlook going forward over the next couple of years, I think there's a risk that the yield curve continues to steepen over a period of time off the back of slower growth, the Fed and the RBA responding to rate cuts, and also probably in the US having more of an elevated inflation environment. So in my view, and not to mention they have a lot of issuance to fund Trump's budget. So to me, the combination all means that probably yield curves steepen over time. So having a fund that can take advantages of all those things, we are a credit fund, but having that overlay helps you to drive alpha, and being more active versus that passive environment, I think is especially the way to be in fixed income.
That was In Depth with Roy Keenan from Yarra Capital Management. Thank you.